Welcome to our deep dive into financial history. Today, we're uncovering the hidden patterns behind some of the most famous financial bubbles in history. From tulips in the 17th century to Bitcoin in the digital age, these stories reveal timeless lessons about greed, speculation, cocaine, and human behavior. Tulip Mania, 1637. Imagine spending the equivalent of a luxury house on a single flower. In the 1630s Netherlands, tulips sparked the world's first documented financial bubble. Exotic Turkish imports became a status symbol, and a virus causing rare color patterns turned tulips into treasures. At its peak, a single Semper Augustus bulb sold for 6,000 florins, 15 years' wages for a skilled craftsman. Futures trading allowed bulbs to change hands 10 times daily without leaving the ground. But on February 3rd, 1637, a routine auction failed, leading to a 90% crash in weeks. The Dutch instituted the world's first financial regulations, but human nature remained unchanged. The Mississippi Bubble, 1720, France's war debt paved the way for John Law, a Scottish economist and gambler, to propose a revolutionary plan, a national bank issuing paper money backed by shares in the Mississippi Company. Promising vast wealth from Louisiana's lands, shares skyrocketed from 500 to 18,000 livres in 2 years. At its peak, the company's value was 80% of France's GDP, equivalent to $20 trillion today. The bubble burst when investors demanded real money, leading to hyperinflation and a 97% crash. John Law fled France, leaving behind a devastated economy. The South Sea Bubble, 1720. The South Sea Company sought to assume Britain's national debt in exchange for exclusive trading rights with South America. Despite Spain's control of the trade, aggressive marketing and political bribery pushed shares from 100 to 1,000. Even Isaac Newton invested, lamenting, "I can calculate the motion of heavenly bodies, but not the madness of people." By September, shares had lost 90% of their value. The aftermath led to Britain's first market regulations, but speculation would persist. Railway Mania, 1840s. Railways transformed Britain during the Industrial Revolution, sparking a speculative frenzy. Investors funded 272 railway companies in a single year, some proposing absurd lines, like one through Windsor Castle. By 1847, Britain had invested more in railways than it had spent fighting Napoleon. Over half the proposed railways were never built, and investors learned that even revolutionary ideas could lead to ruin. This pattern would reappear in the dot-com bubble. The Great Depression, 1929, the Roaring Twenties fueled a stock market boom, with ordinary Americans borrowing heavily to invest. Banks lent generously, often requiring just 10% down. On October 29, 1929, Black Tuesday, the market collapsed, wiping out $1 trillion in modern terms within 2 days. By 1932, stocks had lost 89% of their value, unemployment reached 25%, and 5,000 banks failed. The Great Depression proved that unregulated markets could devastate entire economies. Japanese Asset Bubble, 1980s. Japan's booming economy saw the stock market rise 450% and Tokyo real estate reach astronomical prices. The Imperial Palace grounds were valued higher than California. Banks lent against inflated real estate to buy stocks, creating a vicious cycle. The bubble burst in 1989, leading to the lost decades of stagnation lasting over 30 years. Asian Financial Crisis, 1997. Thailand's baht, pegged to the US dollar, created vulnerabilities as local companies borrowed in dollars but earned in baht. In July 1997, the baht crashed 50%, triggering a regional collapse. Indonesia's rupiah lost 80% of its value, and the IMF intervened with $40 billion in bailouts. The crisis highlighted the interconnectedness of global economies. Dot-com bubble, 2000. In the 1990s, internet companies with .com in their names attracted massive investments. Pets.com raised millions, despite losing money on every sale. The Nasdaq soared from 500 to 5,000, but lost 78% by 2002. While the internet transformed society, most investors lost their fortunes betting on unprofitable ventures. Housing crisis, 2008. Low interest rates and subprime mortgages fueled a housing bubble. Banks bundled risky loans into securities, selling them worldwide. By 2008, $8 trillion in housing wealth vanished. Major banks failed, triggering the Great Recession and proving the dangers of leveraging bad debt. Crypto bubble 2022. Bitcoin rose from $1,000 in 2017 to $19,000. Driven by speculation. By 2021, the crypto market peaked at $3 trillion, but by 2022, it lost $2 trillion. The collapse of FTX mirrored past bubbles.
It's FTX. FTX.
Reminding us that when something seems too good to be true, it often is. Conclusion: the history shows that financial bubbles are not merely economic events, but reflections of human behavior, driven by greed, fear, and the illusion of endless growth. By studying these patterns, we can arm ourselves with the knowledge to spot speculative manias before they spiral out of control. Regulation, diversification, and skepticism are vital tools to safeguard against repeating these mistakes. Remember, while innovation drives progress, unchecked speculation often leads to disaster. Let these lessons guide your financial journey, ensuring that history's mistakes don't become your own. As always, stay curious.